Hello there, I'm Windermere Real Estate's Chief Economist, Matthew Gardner, and welcome to this month's episode of Mondays with Matthew. Now, as we are all aware, the housing market has softened considerably, with the number of existing homes available to buy close to record lows. And today we're going to talk about supply and how the market is starting to adapt to low inventory levels. Now, this chart, it shows the average number of homes on the market by year. And although year to date we have seen a little bit of an uptick, it's clear that the country remains supply starved. And with just over 3 months of inventory, as opposed to the normal 4 to 6, market is still clearly out of balance. But even though inventory levels have risen nationally, I've said it many times before, not all markets are created equal, and this chart shows how supply levels have changed. Now, the data here is representative of the 100 largest metropolitan areas in the country. And the horizontal axis, it shows the change in inventory versus the second quarter of 2022, while the vertical axis, it shows the change in inventory versus the second quarter of 2019. Now, I think you'll agree the difference is stark. Although 2/3 of the metropolitan areas have seen the number of homes for sale improve versus the same period a year ago, just one, Austin in Texas, had more homes for sale in the second quarter of this year than it had in the second quarter of 2019. And even more stark was the fact that inventory levels in 53 of these 100 largest MSAs were down by more than 50% when compared to the same period 3 years ago. Interestingly, on a percentage basis, it's smaller metro areas that saw the greatest declines versus 2019. For example, in Hartford, Connecticut, the average number of homes on the market in the second quarter was just over 900. That's down by 80% from the second quarter of 2019, when there was an average of over 4,400 units for sale. Supply levels were down by 78% in Stamford, Connecticut, 75% in New Haven, Connecticut, and 74% in Allentown, Pennsylvania. Now, it is true that supply levels are generally higher when compared to a year ago, with the greatest increases being seen in select markets in Florida, Tennessee, Texas, and Oklahoma. However, other than Austin, Texas, supply levels remain well below their long-term averages. So how is the market adapting? The answer is actually rather interesting. Even with all the talk of escalating material, land, and labor costs, it's the new home industry that has been taking advantage of the lack of housing supply. And this chart, it shows the share of new homes on the market compared to their resale counterparts. Now, here we're just looking at single-family homes. Historically, new construction makes up roughly 10% of active listings at any one time. But as you can see here, that share has been rising not just since the end of the pandemic, but for the past several years. Although off the high seen a few months ago, 30% of single-family homes for sale this July were brand new. Now, I find this particularly interesting because, historically speaking, a premium was paid in order to buy a new home rather than an existing one. And you can see here the spread in median sale prices, which was pretty stable from 1990 until the bursting of the housing bubble, but it grew significantly starting in 2011. And in 2022, that premium averaged 16%. But when we look a bit closer at the numbers, that gives us a somewhat different picture. And you can see here the spread has dropped to just 6%. And actually in June of this year, the difference was a mere $1,000. With the share of new homes for sale holding at a 4-decade high, the share of sales themselves is at a level we haven't seen since 2005. But even though we know that there is demand for housing, shouldn't sales be constrained by high mortgage rates? Well, what's actually happening is that builders are attracting buyers through the use of incentives. And here we're talking about mortgage rate buy-downs, which are becoming increasingly prevalent across the country. In fact, a recent survey by John Burns Consulting suggested that 30% of home builders reported using interest rate buy-downs more in the second quarter of this year than they had previously. And this is attracting buyers to visit new development communities. An example of these buy-down programs is the 2-1 program that D.R. Horton, the largest home builder in the country, is offering at some of its communities. Now this program, it gives buyers a mortgage rate that starts at 3% for the first year, rises to 4% in year 2, and then goes to 5% for the balance of the 30-year term. Now that's pretty compelling given where mortgage rates are today. The bottom line, as far as I can see, is that the new home industry will continue to take an outsized share of the market for the balance of 2023 and likely through most of 2024. That said, once the market starts to normalize, I expect them to pull back from these incentive programs and are more likely to start raising asking prices. And then we will return to the traditional spread between the price of a new and a resale home. Although it's certainly pleasing that more homes are being built, I still believe that the country will still be running a housing deficit when it comes to meeting demographic demand. And this will continue to hurt first-time buyers, who are increasingly being priced out of most markets across the country. As always, I'd love to hear your thoughts on this subject, so feel free to leave your comments below. But until next month, stay safe out there, and I'll see you all again soon. Bye now.